Good afternoon, everybody. This is Brad Newman with Roof Advisory Group, a division of Fort Pitt Capital, with Chris Shive and Steve Schiffman. And today we're going to chat a little bit about income and estate tax planning for pre-retirees and business owners. So just a couple of quick housekeeping items before we get going. As with most of these, everybody's lines are muted. Questions can be sent in, directly through the webinar. And I'll give you just a quick tutorial here. If you happen to be on a cell phone or an iPad, if you tap your screen down here at the bottom, there'll be a little button that'll pop up for questions, and then you can type your question in. If you are on a desktop computer, in the upper right-hand corner, there's going to be a little orange arrow for you to click. And then from there, you'll see about halfway down the page, a little section for questions that you can click on that and ask your questions. And we'll be taking questions, throughout, as well as the ones that have been pre-submitted. And then finally, right above the questions, there's going to be the opportunity to print the handout, which is really what we're looking at right now. And I think the main value of the handout is it's going to have a little bit of background information on everybody, and most importantly, some contact information for everybody. So if there's something that we're not able to get to, or something that occurs to you after the fact, please don't hesitate to reach out to any of us directly. So just very briefly, I'll introduce Steve and Chris. Steve is a founding shareholder for, Schiffman, Sheridan, and Brown, a multidisciplinary law practice. In addition to being an attorney, Steve also received his master's in taxation, or an LLM, after law school. Chris is with Martin M. Sachs and Associates. Chris is a CPA and did his undergraduate work at Penn State University. And as I said, I'm with Roof Advisory Group, and am a certified financial planner and one of the advisors on the team. So with that, we'll kind of jump in. First question that was pre-submitted comes from what we believe is a doctor who inquires, besides a professional will, what is important about closing a professional practice? And Steve, I'll maybe give you first crack at it, and then let Chris come at it from an accounting standpoint.
It depends what you're going to do when you close the practice. If you're going to sell the business, then it's a question of finding the appropriate buyer, make sure that you've complied with all of the professional responsibilities in handling it. A lot of times you'll sell the practice, stay on for a little bit of time while you transition, and at the end of the day, retire after putting your patients in the new practice's hands. From a legal point of view, it's a question of devising the form of the sale, whether or not you're going to sell assets or whether you're going to sell the entity itself. In most situations, you're going to sell the assets to avoid transferring liabilities to the new buyer. But it's all based on the individual facts. There's not a cookie cutter form of it. You want to have a team to do that determination, whether it's the accountant, your financial planner, and your lawyer takes that first look at it and develops a plan for either sale or closing it down. Closing it down, obviously, for Medicare, you've got 7 years of records that you have to keep and a variety of other problems. So it's kind of a broad overview.
Yeah. Chris, anything specific on the tax side?
Yeah, just a little bit of, with, like Steve mentioned, if you sell the stock of your entity or the partnership interest, it's taxed differently than if you sell it as an asset sale. And it all comes down to, with the asset sale, the underlying categories of assets that you're selling. You have the physical things with the business that you can sell, but then there's also what we call the goodwill value. And from a buyer's perspective, you want to value the hard assets and physical things you're selling as low as possible and have more of the selling price be considered goodwill. And that gives you better tax treatment. You have long-term capital gains as opposed to ordinary income taxed at generally higher tax rates. So that's a negotiation between buyer and seller. But as the seller, you want to make sure you have your team on your side to help steer that negotiation a little bit to get something that's fair and favorable for both parties. The other thing that I see a lot in a selling a practice scenario is, are you going to receive the payment for that practice as a lump sum in one particular year, or are you able to spread that out over 2 or more tax years, which can give you preferable tax treatments because you can spread out the tax impact over those years and maybe keep yourself in lower tax brackets. But there also comes some risk with that when you are holding a note receivable on the new business owner, and Steve can probably speak to that, but you might not be first in line to receive payment if the new business owner isn't as successful as you were with your business. So there is some risk involved, but potentially some tax benefits to spreading out the collection of those sale proceeds over some years.
Yeah, that's a great point.
The more that you can get it to a capital gains treatment, though, the tax effect is not going to be as great in lumping it all together. You're going to max out at that probably 20% bracket, and kind of mitigates against spreading it over that time.
Yeah, and just one final question on this topic, maybe. Don't have any idea, how close this individual is to the sale of their practice, but in a perfect world, when should that process really start?
I usually find that it's usually a 2-year process, unless you know a buyer all of a sudden. But it's kind of it's just that it's a process. It just doesn't happen today. I've decided I'm selling the practice, and you're going to be able to, or shutting it down. And what do you do with the group of clients that you have and the last 30 years of files? And it is a process.
Yeah.
And like most things, it's better for you when you have that time to plan it out and do it. You're not under the gun and under pressure to sell within a very short period of time. In that case, you're going to probably give up some benefits and lose in some negotiations in order to do that. So giving yourself the most time is obviously going to be beneficial for you.
Makes sense. Let's see. Here's another question. Steve, this might be a little bit more germane to you. Asking how do I maintain assets for normal life and life expenses, and then pass the remainder to heirs without having them depleted when entering a retirement community? And I guess one thing that comes to mind when I see that question is, maybe a little bit of what's the difference between estate planning law and elder care law? Because it seems like that might be hitting both areas.
Yeah, well, that question usually comes up where people are worried that a nursing home care is going to wind up deleting all their assets, and the desire that the government through medical assistance winds up picking up your care after you divested yourself of your own assets to your children or whoever your beneficiaries are. The number one thing to remember is that with regard to a retirement community, as opposed to a nursing home, that's all private pay. You know, that's your cost of living. No one's coming and taking your money. That's where you, if you're going to be in a 55 and over community or in a assisted living, that's all private pay. If you're worried about the nursing home situation, you've got a 5-year, what we call a 5-year look back period. That is from the date that you would apply for medical assistance. You look back to all assets transferred more than 5 years from the date that you've applied, looking backwards. So what the key to it is, if that's the real fear of it, is long-term care insurance that will pay for that 5-year period. And if you've got that covered, then you can do asset planning at that time. The elder care lawyers, and I don't do a lot of this work for a lot of reasons, but the elder care lawyers that are really aggressive about it will set up asset protection trusts out of state in Delaware or Wyoming or Montana or Alaska. They're safe haven states where you have to have given the money away into an irrevocable trust at least 4 years, which is the period of look back for fraudulent conveyances, which then bulletproofs that money from creditors, makes it non-available for nursing homes, and thus qualifies you for medical assistance. It also disqualifies you from being able to get at your own money, but it assures that it goes down to the next generation. So if you're willing to live on medical assistance, you can do it. And there are several good elder care lawyers that will do those sorts of planning for you.
Yeah. Chris, any thoughts on that?
I don't know that I do. I mean, Steve's going to be a lot more knowledgeable than I am when it comes to that kind of planning. But, you know, you mentioned the long-term care insurance, and I think a lot of times it just comes back to your long-term financial plan and doing a good job of saving for retirement as you're working to be able to hopefully absorb and account for all of life's unexpected costs down the road.
Well, for whatever it's worth, Chris, that is a question on the mind for, you know, a lot of clients in their 40s already starting to think about, by virtue of seeing what happens with their parents, how do I plan for that next contingency?
As of today, you're at $10,000 a month is the average nursing home facility, so $120,000 a year. I will tell you that the average stay in a nursing facility for skilled nursing is 2.5 years. That's the life expectancy of someone in a long-term care facility. So 2.5 years at $120,000 a year, you're about $300,000.
On average.
Yeah, people with modest income and modest savings, that gets wiped out very quickly. And then there's the estate lien, so that if you wind up on medical assistance and you have a money left in your estate or a house, which is not an available resource for medical assistance, that is subject to the lien on death, and that can be dealt with otherwise. But a lot of intricacies to it that it's kind of beyond the scope of this whole thing.
Yeah, I was going to say, let's kind of shift back more on the estate planning and tax planning side. And one question really deals with a little bit of the changes with regard to how somebody inherits an IRA, 401k, or a qualified asset that up until you know, January 1 of this year, beneficiaries were allowed to stretch those those IRA or qualified plan distributions over their lifetime, the new rule says they have to take them out within a 10-year period. And so the question really, comes, what changes should we consider, given the elimination of the stretch IRA?
Well, I think.
Steve, I don't know if you want. Go ahead, Chris. I'm sorry.
Oh, okay. Yeah, a couple things that pop into my mind from the tax perspective. If you're in the position of inheriting such an IRA, be somewhat familiar with those rules that you don't, it might not be in your best interest to let all of that go for the 10-year period and then take it all out at once. Could potentially put you in a much higher tax bracket depending on the dollar values that we're talking about. If you have the opportunity to plan before the IRA gets inherited, there might be ways to use Roth conversions to maybe get some of that tax at a better tax rate, depending on if you're in your 50s and you're at the peak of your earning potential, possibly you might be taxed at a higher rate than your parents are in retirement, and so they might have better tax efficiencies to do a Roth conversion during their lifetimes. So I think those are the main points that I would think of at this stage.
And I guess, Chris, the person inheriting the IRA, if they've got variable income or they're maybe going to be retired sometime during that 10-year period, they can kind of play around with that 10-year window to say, I'm going to take larger pieces of that as a distribution in lower income years, or maybe wait till I retire and my income goes down significantly and do it in the latter half of the 10-year period?
Yeah, and part of the planning we always look at is there's often this gap between somebody's earnings before retirement, maybe age 60 to 65, and when they have to start taking their own required distributions from their IRA, which was 70 and a half, now age 72. You have sometimes this 5 to 10 year window where your taxable income it's in a trough, and that gives you opportunities. And we always look at doing Roth conversions in that window. It might be a time to recognize certain capital gains if you're sitting on highly appreciated assets that are not in a retirement account. And so, like you said, that could also be the opportunity with an inherited IRA to lump more of the income into those otherwise lower income years for to overall reduce exposure to taxes over the long term. Makes
sense.
From the estate planning, from the estate planning side of it, if you look on the other side of if you should happen to die in your 40s or 50s, where we've got to do the estate planning now. Not only is there the 10-year period, but if your beneficiaries are your children that are minors, you get that 10-year plus the period of time of minors. So if you've got a child that's 5, you've got 13 years plus another 10 years. So you've got 23 years of planning for that. And if you've done an estate plan previously and you have a trust that's set up for taking that stretch IRA, you really need to look at it now, because the language is going to, the act is going to apply. You're not going to have that lifetime any longer. And whereas we used to do conduit trusts for the IRAs or accumulation trusts, it's kind of now you've got you've got that limited period of time, which is kind of crunches the two of them together, and there's not much of a difference between the two. Depending on the amount of the size of your estate or potential size of your estate, you can look at charitable remainder trusts that will have replacement income to replace the tax that's going to occur, along with several other vehicles that you can plan around that 10-year limit that you should look at.
Makes sense. So that's something that people with children under 18 really need to start thinking about now, getting provisions made for those trusts to be funded with qualified dollars.
Right. And in a lot of cases, that's where most of the money is. So if husband and wife or both spouses predecease, then the big dollars that are going to be there for the children are life insurance money and pension money, and the trust vehicle is what you're going to use to take care of the minors. So you've got to kind of put all of that together and get something that makes sense.
And I'll just put a plug in for the importance of doing kind of, I'll say the last 5 or 10% of the process, which is once you've done all the work of drafting documents, creating trusts and everything, is making sure beneficiary designations are updated appropriately. You know, we've, knock wood, not seen that within our client base, but certainly read the articles of, you know, people that just, they forget or they just don't get around to updating those beneficiary designations, and then all the planning they've done is wasted.
Yeah, my favorite is that we do all that planning. You then do all the beneficiary forms correctly, and then the one child talks the parent into putting everything in joint names with the one who's closest, most convenient. That child then inherits everything on death, and there's nothing left for the other 4 kids. It's kind of it defeats everything. So.
Yeah. Well, we could probably spend a whole hour talking about those kinds of situations.
Yeah.
Well, let's talk a little bit. There was another question that kind of circled around, you know, upcoming changes based on the cash flow of the government. I know that, you know, we've done about $2 trillion worth of stimulus with the with the COVID-19. We're on tap for about a $3.8 trillion deficit this year, which will, I think, put our debt to GDP ratio around 106%, which is something we haven't seen since World War II. The question really gets at, and Chris, maybe I'll let you take first crack at this, and you know, not to ask you to predict the future, but what would your best guess be as far as the trajectory of tax rates over the next, you know, 5 or 10 years?
Well, you know, I was thinking as I'm looking at a lot of the recent tax changes, you know, historically we are in a pretty good spot. You know, with the Tax Cuts and Jobs Act a few years ago, you know, pretty much all of the individual tax rates were reduced. The corporate tax rates almost cut in half. You know, for the pass-through businesses, we have a 20% deduction on that income if it qualifies. We have all kinds of accelerated depreciation that we can take advantage of. So, you know, in my career, we're at one of the best tax spots that we've been in a very long time. And it does make you think that there's really nowhere to go from here but the other way. And a lot of that's going to depend on election results and things of those nature that are, you know, we can't predict. But yeah, it's hard to see tax rates going down any further, and I think in a lot of ways it's hard to see them remaining the same. And I think as it comes to estate planning, you know, we've seen that lifetime exclusion just increase rapidly over the years and recently doubled to where now it's over $11.5 million per person. And it's really taken a lot of estate planning out of our jobs with not a lot of people being subject to that tax. And so things like that are an area where, you know, how much longer are we going to, you know, or is Congress going to let, you know, those high wealth individuals off the hook? I mean, that's a good target to bring that back and go back to prior levels. So yeah, without predicting the future, it's hard to see tax rates getting any better than they are now. And so we try to take advantage of what we have available right now.
Good. Steve, how about on the, mostly on the estate tax side? Chris touched on one of the things that I was going to ask you about was the $11.5 million per person exemption.
Yeah. So the planning for the last several years has, since it hit $11 million, with portability makes it 22, or this year actually 23 million. If you have husband and wife, has been focused on income tax planning. Because if you're not going to have federal estate tax owed, then you want to die with the asset, or you want to die with the asset subject to what we call the step up in basis, so that the asset is includable in a federal estate if you were to file one, and thus create an income tax issue as opposed to an estate tax issue. And the best example is if I bought a share of IBM stock today for $1 and I died with that share of IBM and it was now worth $100, and then I sold it the day after I died, or my estate sold it, you'd have no income tax. You'd have no capital gains tax. Whereas if I sold it the day before I died, I'd pay tax on $99. So what we do is, in estate planning at this point, whether you're putting trusts together or you're trying to leverage money to get it to the next generation, is you want to make sure that you have a mechanism in place that you can subject all that property or money to inheritance tax and estate tax, because there won't be any estate tax, and get that step up in basis, especially if it's appreciated assets. Now, if you do it now, today, and then they drop that limit from $11.5 million back to $5 million, the question is whether or not I get the advantage of that lifetime exclusion. And there are clawback regs that were just issued by the Internal Revenue Service, and it looks like you're going to be able to maintain that. So if you're a high wealth asset holder at this point, you want to keep your eye on that, in particular because the way the Congress usually does it is the day the bill gets introduced to do this, they make it retroactive to that day. So you have to be kind of an 8-ball theorist that you can predict the future. But it's something to watch. I mean, while it's not in the hopper and it's not there, look at your assets, look at what you want to do with it. With the interest rates the way they are right now, estate planning, creating less money out of more money in order to pass it to the next generation is the thing that's going to be the focus of estate planning going forward until we know where the tax gurus are going to shake out.
Yeah, Steve, I was going to just ask that as a follow-up question that, given the low interest rate environment that we're in, and the Fed said today that they don't plan on raising rates through 2022, what are some examples of advantages you can, take advantage of from the estate planning standpoint based on very, very low rates?
Yeah, so the way you value streams of income and the way you value businesses is based on 75/20 rates, or the current interest rates, and the lower the interest, the greater the discount on the value of things in the future. Thus, for instance, if we were doing a grantor retained annuity trust or a GRAT, you do that based on a 1 or 2% calculated value. You keep the life interest, give away the remainder interest. Chris's firm would then do a present value calculation of the whole thing. And all of a sudden we take a $2 million gift and turn it into a $500,000 gift if we stretch it out long enough. And thus you can move a lot of assets and a lot of money down to the next generation because those rates are so low. Chris may give us a better idea of it.
Yeah, we've done a few of the grantor retained annuity trusts, and just in the last couple months with the market taking the dip it took, that was a really good opportunity for those individuals in that realm to put some of their reduced value assets into a GRAT. But yeah, we see a lot of, generally the 2-year GRAT is what is most common that I see. That's the minimum that you're able to set up. And it's almost like a form of legalized gambling with your estate, where as long as you're willing to pay the fees, I mean, it's going to be involved. You're going to pay some professionals to set up the trust and to do the valuations and to prepare the gift tax returns. But as long as you're working with enough money to make all that worth it, it's really a no-lose situation where, if the asset does appreciate significantly, you're going to move potentially a very large sum of money out of your taxable estate at a very low valuation against your lifetime exclusion. So it's a really useful tool. With the higher lifetime exclusions, less people probably really need to be doing those kind of things, but I've always found that to be a really interesting and useful estate planning tool if you're in the realm of it making sense to do that.
Yeah, makes sense. We've kind of talked about trusts several different times. They've been mentioned. Steve, what should people think about before they name a trust as a beneficiary? I'm sure I know that's not just an arbitrary decision to make. What are some of the things they should really be thinking about down the road as far as what the implications are?
There are a lot of different types of trusts, and just using the word trust is kind of generic. But I divide it into 3 different types of use for trust. One is for minors. If you've got minors in your family and you're doing estate planning, minors are not allowed to own property, not allowed to have bank accounts. So the trust is the vehicle to take care of those minors if the 2 spouses are no longer around. A individual spouse is not allowed to be for instance, guardian of of money for a child in excess of $25,000. So larger than $25,000, you want to trust as the vehicle for holding the money for the minor children. And if both spouses are gone, it's the vehicle to give the necessary cash flow to the guardians that are going to take care of your children in the future. The second area is investment and estate manipulation planning is the best way to call it. Grantor trusts, people of wealthier who have growth coming in, instead of putting multiple businesses or activities all in the same corporation or all in the same individual's name, we're going to divide it out into multiple investment trusts that we can make hold these assets and get them out of my estate right from the beginning when they're cheapest. So if I create a new business and it's going to cost $100,000 to seed it, I'm going to loan $100,000 to that trust. The trust is going to operate the business. It's going to repay me the $100,000, and that estate, that trust and that business will never be part of my estate in the future. And that's what I call an investment trust or a business investment trust. The trust could merely hold the membership interest in the LLC that actually operates the business, but there's all different levels of that. And then there's the final area of the trust, which is which people refer to as inter vivos trusts or lifetime trusts, where you're getting into your later stages and people want to have their assets managed. They don't want to do it any longer if they become incompetent or incapacitated or not capable of taking out their affairs. Then those trusts will hold that type of money. We create what we call a standby trust that is not funded, so that if some point my power of attorney can then take my assets and put them in that trust to manage it for me in the later ages, later, you know, in your twilight years, as you say.
Right.
But so there's kind of three different areas that you're doing at this point.
Yeah, and Chris, what should people think about as far as tax rates? Because the tax structure for trusts is very, very different than the tax rate for, you know, an individual or a couple.
Right, and so if your trust is structured as a simple or a complex trust, you know, you're going to have capital gains income remaining in the trust, and you can either distribute all other income out or retain some of it in the trust. And if the trust is structured that it's going to pay its own taxes, you know, the tax brackets are very compressed, and you find the trust in the 37% tax bracket at a very low taxable income amount. And so the income taxes at the trust level, it puts you at the highest tax bracket in most circumstances. You know, the alternative to that is you can structure your trust as a grantor trust, which basically eliminates the trust as a tax-paying entity, and all items of income are taxed to the grantor, and it becomes part of that individual's income tax return. And oftentimes that'll also be at one of the higher, if not the highest, tax brackets. I think, Steve, where that really comes into play as a nice benefit, it's in a way of moving additional money out of your estate by you personally paying the income tax on your trust's investment income.
Yeah, that usually works very nicely, especially in ILETs, where we're doing irrevocable life insurance trusts, where you create those as grantor trusts, and thus it permits you to contribute that extra money into that ILET if you seed it with enough money to start paying the life insurance premiums. It's a nice vehicle.
Gotcha. This is a little bit more of a generic question with regard to charitable giving and kind of how it factors into, you know, Chris, on your side, you know, income taxation, and Steve on your side on the estate planning, but specifically asking if there's anything notable coming out of either the relatively recent Secure or very recent CARES acts that are applicable. The one thing, well, go ahead, Chris, I'll let you kind of.
I don't know that I'd say anything significant. There is a new thing is there's a $300 above the line deduction for charitable contributions. So even if you don't itemize, now that the standard deduction is basically double to where it used to be, and you can only deduct up to $10,000 of state and local taxes, most folks, or I should say most, but a lot of folks are finding themselves not in the position to itemize deduction. So there's that additional $300. And also the percentage of your AGI also has increased from 50% to 60% that you can deduct as charitable giving if you do itemize. Another thing that we found useful with the doubling of the standard deduction, we've seen a lot of folks basically get a checkbook for their retirement account, for their IRA. And
We've done a lot of that.
an elderly couple that, maybe they give, $500 a month to their church, and that $6,000 of charitable contributions would normally, not get them any additional tax benefit. If they don't have a mortgage and things of that nature, they're not going to itemize their deductions. But what they can do, they can take that out of their IRA and satisfy their required minimum distribution requirements. And by giving it directly to charity, it makes that IRA distribution not taxable. So it is a way to maintain some level of deductibility of charitable contributions. And by having a checkbook, it makes that process easier. Years ago, it was more of you did it once a year, and you might gift a large sum to a specific entity, but now we're seeing different vehicles to just do your everyday charitable giving out of your IRA, which is helpful.
And Chris, even though RMD's required minimum distributions have been waived for 2020, if you are 70 and a half, you are still eligible to make those direct qualified contributions from your IRA.
Correct. And they actually, that remains 70 and a half, I believe. That did not go to 72, like the change in minimum age for the RMD, which it was interesting, and it will be confusing over time to keep those numbers straight. But they're no longer the same age anymore.
Right.
There is one other thing that you can do is to, but you have to be in the high bracket type of individual, is you can do a donor advised fund. You can make one large lump sum charitable gift, let's say $100,000 or $200,000 to a donor advised fund. Get the deduction now, because now you're going to exceed the $24,000 joint standard deduction. And then over the years, you can advise the donor advised fund of what charities are going to get that money. It depends on the year that how much income you have and how much you want to do, but that's kind of an item that's still available out there.
And Steve, have you seen instances where people have pre-funded the donor advised fund or even created a family foundation really to provide seed money for the next generation to be philanthropic when the parents suspect there might not be the level of interest that the parents had in giving?
Absolutely. I've created a lot of them.
Okay.
They're individuals that have that philanthropic position. A lot of times we'll create a donor advised fund with an exit strategy once we've got enough people interested in the charity itself, and then we'll remove it out of the donor advised fund and create their own C3 charity that they then the family will participate in. The concept is to get it healthy enough that you can get it as a public charity as opposed to a foundation, because you'd rather have a public charity than a private foundation if you don't have to have a private foundation. It's a way of getting you through that interim period of time of growth.
Yeah, I was going to ask, are people still using the private family foundation with the advent of the donor advised fund, or is that pretty much gone out of the mainstream?
Yeah, it depends on the financial ability of the client. If you got a client that can put $1 million into it, you can get it up and running and convert it ultimately.
Okay.
Yeah.
Okay. Let me see here. Chris, this might be for you. A question on qualified business deduction. What kind of income tax planning opportunities surround that?
Yeah, so the qualified business deduction, that was a new pass-through business deduction that came out with the Tax Cuts and Jobs Act. 2018 was the first year that we had that, and that's in place through 2025. It was implemented for 8 years, and it's a really nice deduction to give your business a 20% deduction right off the top, and its purpose is to somewhat mirror the lower tax rates that the larger corporations are enjoying right now as well. Yeah, there are some exceptions to that, so you got to be careful if you have a business that's what they consider a specified service trader business. It's a lot of the professional services. Probably the three of us here are all in the types of businesses that the IRS says we don't want you to enjoy this 20% deduction if you get over a certain income threshold. Doctors, lawyers, accountants, investment advisors, certain professions like that are excluded once you get up into the higher income levels. But in order to maximize that deduction, you do have to make sure that you meet the criteria. And one of the big things is, once you do get over income thresholds, you are expected to maintain a certain level of payroll and or assets that you're purchasing and maintaining in your business. So we try to make sure that the businesses are meeting those criteria. And in an environment where you have a business owner that might own a handful of businesses, there's mechanisms that we can use to aggregate those together for the purposes of the qualified business deduction. And that way you can stretch out the benefit of payroll and assets held by particular businesses to benefit all businesses. So those are the little things that we look at to make sure we're maximizing that deduction, because it's a really significant 20% deduction. It is set to expire at the end of 2025. So we want to use it as much as possible. And one thing that we'll run into in a few years, the mantra forever has always been defer income, accelerate deductions in order to just maximize the time value of your money with tax dollars. In 2025, we might be in a situation where we are accelerating income and deferring those deductions because you're either going to get the 20% tax deduction or you're not, and it might be better to have more income to maximize that particular deduction.
Makes sense. It looks like we might have just, kind of two more questions. And Steve, this is obviously going to be one for you. As far as just, basic estate planning documents that everybody should have, or if they have them and maybe haven't updated them recently, what would you say would be kind of the baseline things that people should be thinking about?
Yeah, the minimum documents that we recommend people have are a power of attorney that gives at least the spouse, if you trust that person,
hopefully
the rights of a financial power of attorney. A lot of people think that just because you're married, you have the right to sign the other one's name. You'll find that financial institutions, brokerage houses, real estate transactions don't work like that. If something should happen to your spouse and they are not capable of handling their own affairs, you're going to wind up in the orphans court in Pennsylvania with appointment of a guardian. So a power of attorney can substitute for that. There's two types. You want either a springing power of attorney that only takes effect on the disability of the principal, or a one that vests immediately. If you trust each other, I usually recommend that you vest it immediately. You have a alternate power in case both husband and wife are in an accident where they're both incapacitated. Then you have an alternative individual that can take care of that. The second type of document is called a healthcare power of attorney. There is a a base state form that's been promulgated that's really pretty good. And that provides for two things. It provides for one, a healthcare surrogate, which permits you to provide for HIPAA rights, where the spouse then has the right to talk to all the doctors and provide for care for the individual. And then the second thing it provides for is end stage illness, where there's little likelihood of recovery. It then gives that spouse or whatever individual that you give that right to make those decisions. And then there's a lot of subsets in that you go through and check off and decide how you want to plan on that. The third document is going to be the will, and it's either going to be a will that sets out who gets what you do with minor children, guardians, whether we put trusts in it or not, at younger ages, at older ages where there are no longer minor children, and we have large amount of assets, we may have an inter vivos trust or a living trust that's outside of the will that will then be a pour over, where you'll pour that will into that trust to provide for certain things to occur. So power of attorney, healthcare power, wills, and a potential inter vivos trust to go with it. Kind of the basic game plan.
Good, good. And Chris, the other question is probably squarely in your court, which is, what are some triggers or what are things that would, tell me it's time for me to call an accountant to have my taxes done on a professional basis?
Well, I think anytime you're working with a business, you're going to want to use an accountant to help with your business tax returns. Even if it's a sole proprietorship, that becomes part of your personal tax returns. I think having an accountant that's going to have an understanding of what the end result should look like is going to be beneficial there. And at the personal level, we have TurboTax and all these tools now that almost anyone can do a simple tax return. And in many cases, we're not necessary to do a tax return for somebody that has a W-2, maybe a little bit of interest income and a standard deduction. As you get into higher income levels and you get into various investments and different types of retirement account income and planning, and that's really where you're going to want to use an accountant to make sure you have your taxes prepared accurately, first of all, but also, as you get into certain levels, you have more planning opportunities, and the tax savings from making better choices, from a tax planning standpoint, are going to be better than saving the money on not paying a preparer. So those are the circumstances when I say you got to use a professional and maybe ditch the TurboTax for. But a lot of people use it. I don't even do my parents' taxes. They do TurboTax, and they call me when they have questions. So
they've got a pretty straightforward situation, I'll bet, though.
Yeah, they're relatively straightforward. But once you get beyond that, then it's probably time to call a professional.
Gotcha. I believe that we've gotten through all of our questions here today. So I think this is going to be a good opportunity to kind of wrap up. I certainly want to thank Steve and Chris for their time, their expertise, their willingness to be a part of this. Like I had said earlier, please don't hesitate to reach out to anybody with questions. Bio info is still there on the screen. And this will be, I guess, your last opportunity to kind of download that document. But also we will be sending out a link for a rebroadcast of this to anybody who had attended. So I want to thank everybody who attended. I do also want to let everybody know that we're going to be doing another one next Wednesday that will focus on estate planning considerations for retirees, people kind of on the other side. With that, once again, Steve and Chris, I thank you and thank everybody for their time.
Thanks for having me on.
Thanks a lot.
All right. Thank you again, both.